Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
It's not if your health fails, but when your health fails. And when it does, your spouse, your kids, well, they're the ones who are going to pay the biggest price in caring for you. If you have a parent who is a veteran, well, we have a way to get thousands of dollars from the federal government to help you pay for long-term care if and when you need it. Then later, if you're 73 or older, did you know the formula for calculating your RMD will be based on the account value of your retirement account December 31st? And if you did, then what will you do now when your account may be up 20% and you have to take your RMD? Well, all this and so much more, so stick around as we talk about the things that you want to know. Good morning, I am David Hollander, your host. This is Protect Your Assets. For those of you just joining us for the first time, welcome. People around here, you hear the jingle, they call me the Sandman. That's because I help you keep more of what's yours by answering your questions. If you have a question, something's come up. Well, we have been practicing law, doing taxes, and managing money for over 30 years. You can always email me your question too. Something comes up during the week. We love those questions. In fact, this one came up from this week, the show, questions@pyaradio.com. That's where you email me. Questions@PYA for Protect Your Assets, radio.com. I was just talking about long-term care because just the other day, I was talking to a childhood friend of mine about his mom. You see, my friend Ian is in his mid-50s and his mom is 84. She's a widow, but has been in very good health all of her life until a couple months ago when she was trying to help a friend out in the garage. You see, she climbed up on a chair and was reaching for something when she fell. She broke her right hip and now she's receiving in-home care in her home. And she is fiercely independent. She lives alone and has for quite some time. And she wants to handle all of this on her own, and she doesn't want to burden her kids. So Ian is looking into his crystal ball 1 to 5 years down the road, and he knows this isn't going to get any easier because she just needs help. While at the same time, she wants to be independent, and there is no plan in place. So he's asking, well, how can I still work and earn a living and care for her at the same time? And what will this cost? Is this going to decimate all the savings? And then what do we do? Who's going to feed her? Who's going to bathe her? Who's going to help her get dressed in the morning? What about all the groceries? These are all the questions that are running through his head in the middle of the night. Unfortunately, I've seen this movie over 1,000 times while I've been doing this, and here's what you don't realize. It's not if your health fails, but when your health fails. And when it does, usually it's your family. They're the ones who pay the biggest price. They're the ones who are going to have to care for you, and they're the ones who are left holding the bag on the bills that sometimes just wipe you out. So this isn't a matter of simply buying an insurance policy. It isn't rocket science. We have strategies for you this morning that will help you think through this, look at some options you might have. So stick around for the entire show as we walk through what you need to know about this important subject before it's too late. All right, well, let's get started on that happy note. The Dow had a pretty good week, up 1.1%. S&P up 1.1%. NASDAQ up 1.3%. And the international index continues to climb, up 1.7%, up 23.3%. Year to date, that is the star. 10-year Treasury hanging in there at 4.12%. Oil down pretty big this week off 7.5%. Closing at $60.67 a barrel. And of course, we had the federal government shut down. And as a result, there will be no Fleet Week. Anyway, we also didn't get the jobs report for September because they weren't there. So what do we expect as a result of all this? Well, I expect a short-term slowdown in growth during the shutdown, followed by a pretty quick recovery once the funding resumes, because typically furloughed federal workers are guaranteed back pay. The shutdown tends to delay rather than eliminate spending. And of course, economic activity is still strong. So overall, in our view, the direction of travel for rates and the market overall still looks pretty good through 26. We had the third quarter just end, and markets wrapped up with a pretty strong note. Just looking at the third quarter, S&P gained nearly 8%. The tech-heavy NASDAQ, well, that was up 11%. And the Russell 2000, which is a proxy for small cap, small businesses, performed even better, had a 12% rally overall. So despite the government shutdown, investor sentiment is pretty resilient. And the S&P 500 has notched 3 additional all-time highs, bringing the year-to-date total to 31. It's a pretty strong year overall. So what are the forces that are fueling the strength, and will this continue? That's been the big question. And so overall, the tailwinds we're seeing from the AI innovation continues. Rapid development and adoption of AI continues to drive this market. Semiconductor stocks, which enable the build out of the AI infrastructure, well, they've led the gains this year and this past month in particular. And this is supported by accelerating investment in data centers and AI capability. You add to that, there's cyclical momentum right now from lowering rates, with the Fed resuming easing, cutting rates, talking about cutting rates again. All those rate-sensitive areas of the market are coming back. Like what? Well, cyclicals, consumer discretionary, small and mid-cap stocks, and emerging markets. All of that pretty good. So the bottom line, we think the combination of a growing economy, rising corporate profits, and declining interest rates overall support a positive outlook for stocks. This doesn't mean that we're not going to have volatility, and this month, of course, is the one that usually brings it. So we'll see what happens. All right, when your health fails, your spouse and kids are going to pay the biggest price in caring for you and ultimately paying for the outrageous medical bills. It is supposed to be Fleet Week, but that's been canceled. So in honor of our veterans, I'm still going to go ahead and share some ideas with you. Even if you are a federal employee, there are thousands of dollars available to you. So let's find out all about that when we come back. You are listening to Protect Your Assets Show. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander. They call me the Sandman around here. And if you're just joining us, earlier I was talking about my friend Ian. You see, his mom recently fell and she broke her hip. And now he's not only worried about her well-being, but who's going to care for her since his dad has passed away. Ian's dad was a veteran, and so his mom may be entitled to a tax-free benefit from the federal government. So I was just talking about my friend Ian, and unfortunately his mom had an accident. She was trying to help a friend out, and she fell, and she broke her hip. This happens so often. And since my friend Ian works and his mother lives hundreds of miles away, he's looking at hiring a full-time caregiver to help take care of her while she's at home recovering, because she needs some help just to make her meals and to go shopping, help her get out of bed, all those sorts of things that we take for granted. Well, all of a sudden they become real. So in any event, this is what's going on right now. And so we went over the list of what you want to do when you interview a caregiver. And so I do have a book. It's called Protect Your Assets. And we will go through the long-term care chapter right now with some ideas for you. If you miss any of this, you can grab it and you can find it there. But this is sort of a checklist you want to go through as you interview a caregiver. You can even do this over the phone. I recommend via Zoom if you can. Are they licensed and bonded? Why do you care about that? Well, there's a lot of theft typically. This happens quite a bit. And if you want to be insured against that, you want to make sure they're licensed and bonded. Also, find out what the experience of the staff is. And hopefully they have more than just one person working there. So find out if they do, because typically you'll have things come up, like their car will break down, it'll be a problem, and you're expecting someone to show up to help with medications or just getting up in the morning, getting out of bed. And if the person can't make it, well, then you have a problem. So make sure they have multiple people on staff that could jump in there and help out. And are they friendly? Are they easy to reach? All these things are things you want to check off and make sure and double check. Is there a licensed nurse or a social worker on staff or available? How will they provide you communication on staffing as well as how your mom is doing? A lot of people like texts, so you can get text updates, reminders, emails, of course, but make sure they're communicating with you, especially if you're hundreds of miles away, about what's going on. All right, now let's talk about cost and how do you pay for this, because this is always the big one. It is expensive. Let me give you some numbers here. Again, you can do this research yourself. There's a great website put out by Jen Worth. And according to them, the typical California resident pays about $6,800. You heard me right, $6,800 per month for home care. And that's for about 40 hours of care. Now, my buddy right now, he's looking at 24-hour care because his mom needs help. She broke her hip. She really can't get out of bed. She needs assistance, and that could be at any time. So he's looking at full-time 24-hour care right now. And for a month, right now, according to this website, it's running about $25,000 a month. Yeah, it's expensive. What are some other options for care if you're ambulatory, if you're mobile? Well, adult daycare is an option for some, and in this state, it could be anywhere from $1,500 to $2,500 a month for that. This allows you to live at home and get personal care during the day. You get meals, you get activities. You're in a community setting. You just have to get there. So there are rideshare services available. I don't know if you've seen the new Robo-Taxi, but that's kind of cool. You can just order a taxi, send it to your person's house, and picks them up, drops them off. Assisted living. This is an area where you live at either a community or a board and care facility. And usually in assisted living, they provide these types of services like meals and personal care and activities, along with housing. And that usually is running around $6,250 a month, according to this site. And if you increase it to, say, nursing care, well, that could be as high as $12,167 a month. Now, the next question you should ask, which Ian did because his dad was a veteran, and after all, it's supposed to be Fleet Week. I'm still celebrating, even though they're not coming to town. Really bummed out about that, by the way. Anyway, if you're a veteran or your dad or your mom was a veteran, maybe they were both veterans, then there's a veteran benefit. It's called the Aid and Attendant Benefit, and veterans are eligible for dollars, tax-free dollars, to use for long-term care if you're facing something like this and your health gives out and you're looking for ways to pay for it. So let's walk through that a little bit, shall we? So first of all, you need to determine if you're eligible. So did the veteran serve active duty during a time of war? Second, is financial assistance required to help pay for the care you need? Does the veteran or surviving spouse of a veteran, this would be Ian's mom, require assistance from other people with activities of daily living? Like what? Well, bathing, dressing, medication management, transferring, toileting, these sort of things we take for granted. Will the assistance from the other people be paid for by any other sources? Like what? Well, like a long-term care policy. Was the surviving spouse married to the veteran at the time of death? If you can answer yes to these questions, then you could be eligible for the following here in 2025. The veteran is eligible for $2,750 a month, and that is tax-free, paid to the veteran to use for care. If you are the surviving spouse of the veteran, in this case that would be Ian's mom, she could be eligible up to $1,478 a month to use for care. And if they were both veterans and both still living, get this, she could get up to $3,650 a month, tax-free. That's pretty good. So, if you're a veteran or your spouse was a veteran, this describes you, then give me a call right now to get a copy of our guide on benefits for veterans when it comes to using this important aid and attendance benefit for long-term care. It's yours right now. We'll go ahead and email that out to you, but we'll need your email. So give us a call, 866-PROTECT. Our phone number to call right now to get yours, it's 866-776-8328. Again, 866-PROTECT. Hang on to more of that money. PROTECT, 866-PROTECT. Call us right now. Speak to a member of my team. We are here right now on this beautiful Saturday morning, ready to help you out. Give Zach or Lucas a call, 866-PROTECT. Ask for the brochure. They'll get some information from you, and we'll be happy to share that with you. Coming up next, it is time for our popular They Say segment, where they say at age 73, you must take your RMD from your retirement account. Is that always true? We'll find out when I come back. You are listening to Protect Your Assets with David Hollander. That's me. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAEvents.com and signing up for our next free event. That's PYAEvents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And if this is your year to be taking your RMD, there are so many choices, and it can be so confusing, particularly if you have a 401k, a traditional IRA, maybe a 457 account. How do you figure all that out? And you add to that with the government being shut down and the market at all-time highs right now, which will affect how much you have to take, because after all, 12/31 is the date when they calculate your RMD. So depending on all these factors, what should you do? Well, that's a great question. So we're going to be talking about that in this segment. But before we do that, I wanted to ask you to go check out our podcast, because if you missed our market segment, where I was talking about what the government shutdown means to markets and where it could be going before the end of the year, you want to go check out the podcast. So how do you do that? Well, if you use Spotify or iTunes, just go to the search glass, type in Protect Your Assets. When you get there, you'll see there are two different podcasts. There's one that's got my profile on it, and that is the market segment. And that's where we give you a quick market update on what we see happening, any changes we've made, and where we think things are going. And then you'll also see the other one with the little Sandman character with the little pixie dust sprinkling there. That's the actual show. And so if you want to learn more about what we're talking about today, RMDs, for instance, Just look for the show that says RMDs in it, or IRAs, or things like that, and then you will find it there. If you enjoy what you see, please share that with your friends. We really appreciate that. All right, now it's time for one of our fan favorite parts of the show. This is our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All right, so here's one they say. They say that when you turn age 73, you must take all of your RMD from your IRA or other retirement accounts. Is that always true? No, it's not. If you are aware of something called a QLAC, or you're thinking about a QLAC, maybe you're 73 and you don't know what a QLAC is, well, pay attention, because you have options which could make that statement false. So what is a QLAC? It's short for a Qualified Longevity Annuity Contract, also known as a QLAC. And what this is, it's a special type of deferred income annuity. It's a fixed annuity that you can buy inside your retirement account. So if you have a traditional IRA, maybe a 401k, 457, 403b, any type of SARSEP, KEHO, things like that, you can take a portion of that out, not have to take the RMD on that, and stick it into one of these accounts. Now, these accounts are designed to provide guaranteed. This word comes from the insurance company's ability to pay you back. That's what that means. So you have to look at that. But it provides a lifetime income stream, very much like a pension would, later in life. So if you're 73 this year, you're turning 73, then you can delay the RMD on that chunk of money all the way up until age 85. That's right. So how much can you put away? Well, you can do up to $210,000 when you look at your full account balance. And now under the Big Beautiful Bill, this all started with the Secure Act 2.0, and then, as you know, the Big Beautiful Bill, the new tax law passed this year. It's now effectively the law. And now it allows, it's a permanent approval of up to $210,000. This should be adjusted for inflation, to be taken from your retirement balances. Now, how do you do that? Well, you have to add up the value of all of the accounts to determine what the factor would be. And if it's $210,000 or 25%, whichever is less, you pull that out and you put that into one of these QLAC accounts, and then you can delay the RMD until you reach age 85, and then you start to take that out. The money that you put into the QLAC, that stays tax deferred. It's not tax free, and there is no tax when you transfer it. So you can transfer the money over into the QLAC account, not have to pay tax on that transfer, and then you just let it grow in there. And then as you start to pull that out when you choose, or wait all the way until you're 85, then that will come out as ordinary income. But while it's deferred, the amount is excluded in the account. So whatever's in that account, that gets totally excluded from your RMD, your required minimum distribution calculation. In other words, you don't have to take that money out, and you don't have to pay taxes on it now. So why would you do that? Well, because it could lower your overall taxable income. When you look at your Social Security, when you look at your pensions, maybe rent from property, maybe you're having a pretty good year and it looks like you're going to have a pretty good year for a few more years. Well, you might want to take this piece of your account, stick it away in something that's not part of that calculation, and pay less taxes. It's certainly an option. And what's different about the QLAC is when it starts paying out when you start get that income at age 85 or when you choose to do that, it has to be earlier than that. It's the latest you can go. But when you start to receive those income payments, those payments are guaranteed for your life, backed by that insurance company and their claims paying ability. So that's why it's like a pension, because that payment will continue for as long as you do. Even if you go longer than what's in the account, they still have to keep paying you. And again, that's coming from that insurance company, which is, by the way, what a pension is. I don't know if you know that. Pensions are essentially a single premium immediate annuity, something called a SPIA in my business, where you take a chunk of money, you give it to an insurance company, they turn around and guarantee you a payment for as long as you're alive. And why you do this is because of the longevity risk, meaning if you want to take that risk off the table, if you're not sure how long you're going to live, I mean, I don't know many people who do, right? How long are we going to go? If you're worried about that, worried about running out of income, well, this is a way where you can provide a income stream for as long as you live, even if you burn through that entire account. So that longevity protection could be important to you. And this would also give you a hedge against outliving your savings. These are also pretty simple because you don't have to manage the investments in this part of your portfolio. The annuity will pay you when you determine the age you want to take it out, and that is, again, set, so it won't change. And with rates higher right now than they've been for quite a long time, there's some pretty attractive rates. What's another good benefit about this? Well, estate planning. Some QLACs include what's called a return of premium, an ROP rider, or a joint life option for a spouse. So that what that means is, let's say that you were to pass away before you turned the income on, or you just turned it on and then you passed away. Well, you could have a rider in there. Well, it paid back all of the premium to your beneficiary. So you didn't lose that like some pensions out there where you lose all the balance. You could also do a joint life option for, say, your spouse. So if you were worried about him or her losing that income if something happened to you, well, if you pass away before they do and you haven't exhausted that stream of income, well, those payments would continue on to your spouse. So that would be a way for you to provide some estate planning for your spouse in the event that they needed the money to live on and you weren't there. What are some trade-offs? Well, once you buy it, the money is illiquid. So you can't go back and access it, even if you change your mind, because it is, once it's fixed, that's it. Also, remember, the payment that you elect as you choose when it's going to come out, that is fixed. And usually there isn't any sort of inflation adjustment. So if you were going to receive, say, $2,000 a month for the rest of your life, well, that $2,000 will stay consistent and won't increase typically if inflation is there. So know that. So sometimes payments look pretty good, but that should be part of your total plan, not certainly all of your plan, okay? And that's why, again, they only allow usually a percentage of your account to do something like this. And you also, like I said, want to look at the insurance company's financial strength and evaluate that to see if it's a good complement to some of the other things you're doing in your portfolio, like maybe AI. Maybe you're buying some more speculative things and you want to provide some safe money in there, because in short, the QLACs are like a pension that you buy for yourself using a part of your IRA or your 401k to start paying you that steady stream of income later in life while lowering your RMDs right now if you're turning 73 this year. So if you want to know more about this, let's say you were born after 1960, then your RMD is 75, so you've got a couple more years to think about this. If that describes you and you're sitting in this position right now and you're wondering how you might take a piece of this off the table right now while markets are high, don't stay up all night thinking about this stuff. How do you get help? Pick up the phone right now. Give us a call. We're happy to share with you these ideas and how we're doing it for our clients right now. 866-PROTECT. If you want to find out how to not take an RMD, 866-776-8328, 866-PROTECT. To keep more of that money in your pocket, keep it growing, keep it safe, 866-PROTECT. It's time for a quick break, but keep it tuned right here because when we come back, I'm going to continue talking about my friend Ian and what else he could do to protect his mom because she did have a fall recently. And he's wondering what options does he have to make sure that she's okay. You'll only find it here this morning, so keep it right here. You are listening to The Sandman. We'll be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And it's not if your health fails, but when your health fails. And when it does, who picks up all the pieces? It's usually your family. And then to add to that, all the cost of the medical bills that keep coming in. And then it's just so difficult to recover. And typically you need lots of help just to do basic things that you took for granted. So what can you do right now to make it easier for those who are going to help you out when the time comes? Well, that's what we've been talking about this morning. And I'm very sorry about the Fleet Week next week. I know it's been canceled. It's a bummer. So we tried to help out our veterans, thank them for their service by talking about the aid and attendant benefit. It's a very special long-term care benefit that we talked about in our previous segment. If you missed that, you can go back and listen to it because there are some serious dollars there, literally thousands of tax-free dollars there for service people to use for long-term care. You just have to know how to get it. So check out our podcast wherever you get your podcasts. Type in Protect Your Assets, long-term care, and you should find it there. So I was talking about my friend Ian. We were talking this past week. His mom was helping out a friend. She's in her mid-80s. And unfortunately, she took a fall and broke her hip. And now she's convalescing at home, and he's hundreds of miles away, and he's very worried about what he's going to do to help her through this because she needs help. She can't get out of bed. She can't go shopping for her food. She can't bathe herself. It's very hard to get dressed. All these things we take for granted that are so easy for most of us, well, just takes one thing to happen, especially with a leg or a hip or something like that. Now you're stuck. So this morning we were talking about options for long-term care because that's what this is. Typically you fall into this like she did and has to go to the hospital and have a big surgery. And if you recover through that, then the bills start coming. You wonder, what are you going to do? How are you going to pay for all this? And so in my book, Protect Your Assets, which we've been giving away this morning. We have a PDF of it. We're happy to share it with you. If you just give us a call, we'll give you that information here in a minute. I have a chapter that's devoted to the burden of rising healthcare costs, Chapter 7, where we go through all of your options when it comes to what Ian is facing right now. And so I already covered the aid and attendant benefit. Another option is Medicare and the Medicare supplements. Typically, most folks use this, like his mom just used it in the hospital to have the surgery. Medicare will pay for most of that, and her supplement should cover most of that with some kind of a deductible. But it runs out. And with a situation like this, which is looking like it's going to be long-term care, which is typically something more than 100 days, you're looking at other options to pay for that care. And if you want care in your home, which she does. She doesn't want to go to some facility, and she's going to have to reach into her pocket and pay for it. And so I've got some ideas in there and some websites you can check out on how you do that. A lot of people use their own savings. It's another way to do it. You use your 401k balance or your IRAs or some of the money you've saved or equity in your home through a reverse mortgage or something like that to pay for care. That's all something you could do. It's called private pay. Some people have long-term care insurance or have asked about that. Should I get long-term care insurance? Again, I've done an entire show just on that subject. So if you want to know all the ins and outs about that, because there is a lot to talk about in that space. And now there are many different types of policies available to you. Maybe even your life insurance policy has long-term care in it. You just didn't know it. There are ways to get money out of these policies to help pay for things that, frankly, can be quite expensive. And if you don't have insurance, really could take a pretty big bite out of your savings plan. So look into long-term care insurance. That is another option for you. And most recently here in California, they did, and they are changing Medicaid quite a bit. So it's called Medi-Cal. And there are some protections that are in that system for those looking at long-term care. They just changed the rules again on that. So that's always changing and moving. And so I recommend you get with an attorney or someone who's skilled in this, who's been doing it for several years, who understands how to use those things, use those benefits for the type of care you're looking for. And then, of course, figure out what type of care you want, because maybe home care is not practical, at least for a period of time. Maybe you need to go to some sort of a facility. And so there's ways you can research and find ones that really aren't that bad, actually can improve someone's life quite a bit, even for a brief period of time that they need it. So there are ways to look at that if you haven't been through this, if you just want to walk through that exercise and see what can happen so you don't worry about it, so you're prepared. If you're going through it right now, then call us, and we're more than happy to help you. Call the number 866-PROTECT. That's our number, 866-776-8328, because retirement can be uncertain. These things can come out of nowhere, change your life, and then you want to know what you can do. We'll get in front of that now. It's not too late if it hasn't happened to you. Remember, it's not a matter of if, it's just when these things happen. Be prepared. Take the uncertainty or as much of it out of the equation as you can by picking up the phone and calling us and have a consultation with one of our representatives who is skilled in this area. And we have lots of experience, been doing this for over 30 years. We've seen literally hundreds and hundreds of cases, helped thousands of families with this sort of issue. It's not new to us, but it could be new to you. So don't make that mistake. 866-PROTECT. Pick up the phone right now. You got Lucas, you got Zach up there. 866-PROTECT answering the phone this morning. They'll be happy to set up a meeting. It's complimentary again. Just like to help you. 866-PROTECT. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. Executive producer, network manager, Kevin Renfer. And, of course, all my fabulous producers up there doing the work. You got Raph, you got Zach, Nick, Dylan. Thanks, guys. Lucas, because out my team, I'm just another pretty voice on the radio. You have been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.